Okay, well, good morning, everyone. Welcome to Hammerson's full-year results. As usual, I'm joined by Tom Drakesmith, our CFO, also Jean-Philippe Mouton, our Managing Director of France, and Peter Cole, our Chief Investment Officer. They're here to answer any questions you may have at the end. As you know now, it's been a busy year for the business, and I'm delighted with the progress we've made in terms of improving the quality of our assets, generating consistent income growth and delivering on our development projects, all in line with our strategy. He pauses. There we go. So, turning to the presentation, I'm going to take you through the 2015 highlights and recap on how these fit in with that long-term strategy and ambition. Then Timon will update you on the numbers before we take a closer look at the portfolio performance. I'm then going to come back and do a quick wrap before opening up for your questions. So let's turn to the highlights. As I said, it was an active year for Hammerson, and we've significantly strengthened our portfolio. We continued to deliver consistent, strong growth, with earnings per share up 12.6%, NAV per share up 11.3%, and a total property return of 12.4%. And that's outperforming our estimated IPD by some 250 basis points. We extended our pan-European platform, entering a new market through the acquisition of a loan portfolio in Dublin. And we continued our focus on lifting the overall quality of the portfolio, recycling some £360 million worth of assets and recognising proceeds well ahead of book value. We delivered some 65,000 square metres of new space through our development pipeline and generated a profit on cost of 25%. And at an asset level, the focus on our product experience framework and intensive asset management strategies continued to deliver successful results, with like-for-like net rental income up 3.1%. For many years now, we've pursued a strategy to improve the overall quality of our portfolio, and 2015 has been particularly active. So it's worth pausing briefly to reflect on our investment management approach, which drives acquisitions and disposals within our business. So let's start with the top left-hand box. First, we look for European market segments where we have or can achieve a leading position and critical mass. Now, that might be geographical, as with the UK, or it might be segmental, as with premium outlets. At a macro level, clearly strong economic and consumer fundamentals are important. However, as illustrated by the top right-hand box, we look at winning European cities as much as countries. We think just as much about Birmingham, Marseille and Dublin as we do about the UK, France and Ireland. Moving clockwise to the bottom right box, once we've identified a target market, the property itself must have characteristics which match it to the latest consumer trends. In our world, experience, convenience and luxury global tourism are key. And then finally, in the bottom left box, we look for asset management opportunities where we can apply our existing expertise to add value. So turning to look at how our acquisitions in 2015 fit with our investment management approach. As you can see on the left, our acquisition in Dublin clearly meets all four of our criteria, representing a significant portion of Dublin's prime retail and taking a leading position in the fastest growing European economy. Within the portfolio, Dundrum is one of Europe's top 10 super prime centres, and elsewhere the assets are well positioned, with very significant development potential for the future. We continue to engage positively with the borrowers towards taking ownership of the assets by the summer of this year. Similarly, Grand Central is clearly aligned with our strategic criteria. Birmingham, an area we know well, is the UK's second city, and we have the ability to apply our management experience from Bullring to this premium retail offer. And bringing this right up to date, on Friday last week, we announced a 50-50 joint venture with CPPIB, agreed on the same terms as our original acquisition. And finally, more activity within our outlets portfolio as we deployed a further £46 million to the segment through the new acquisition of Festival Park in Mallorca and an increased stake in Kildare Village. Overall, capital deployed through acquisitions over the past 12 months has boosted the quality of our assets and embedded significant future growth potential within the business. And applying the same rigorous criteria to disposal activity, we've completed some £360 million of disposals from across the portfolio over the course of the last 12 months. And those were at a total of 9% above book value, which is clearly a great result. We spoke of our plans to accelerate the disposals process in September when we acquired the Irish loan portfolio. And since then, we have realised £200 million from a combination of UK and French shopping centres and retail parks. Furthermore, we have identified an additional £300 million of disposals, which we expect to complete over the course of this year. So this consistent approach and focus on our strategic priorities has once again produced excellent results, as demonstrated by our 5-year performance. Our IPD beating total property return increase has driven NAV growth of 11%, and we've delivered double-digit earnings growth. Our consistent focus on income growth from our high-quality retail portfolio is well positioned to continue generating reliable future earnings and dividend growth of 6 to 8%. With that, I'll hand over to Timon to take you through the financials.
Well, thank you, David, and good morning, everybody. I've got 4 areas to cover today. As you can see, I'll review the 2015 financial performance, analysis on valuation trends, details on recent changes in debt levels, and the funding capacity for our development pipeline. So first, the headline results, which show positive levels of growth consistent with our long-term targets. Net rental income at £318.6 million is up 4.3% on 2014 due to rents from recent developments, acquisitions, and a good underlying like-for-like increase. Adjusted profit is up 21% on last year, driven by growth in rental income, premium outlet profits, and lower financing expenses. And this translates into an earnings per share figure of 26.9p, a rise of 12.6% on 2014. Our total dividend at 22.3p a share is up 9.3% year on year. Turning to the balance sheet, the property portfolio, including outlets, was valued at £8.4 billion at December 2015, showing a capital value uplift of 7.1%. NAV per share came out at £7.10, up 11.3% on 2014, boosted by the increased portfolio value. And LTV is up since the end of 2014 at 38%, but below our financing policy of 40%. So next, I'd like to examine trends in rental income. So here, I've summarised change in like-for-like net rental income by sector, and the dark blue bars represent growth in 2015. On the left, you can see UK shopping centres generated an uplift of 2.1%, with significant contributions from centres such as Silverburn and Union Square. Like-for-like gross rental income was up 2.5%. UK retail parks posted a 2.6% improvement in like-for-like NRI, with a positive impact from a variety of asset management actions. French retail had a decent year, with Sergi, Saint-Quentin and Italy being the main drivers of a 2.5% uplift, with no help from indexation. The subtotal of 2.3%, shown in the grey bar in the centre, is above a long-term target of 2%. And on the right, we've shown premium outlets like-for-like growth of 7.3%, which gives a group total of 3.1%, shown in the green. Now on this page, we present the adjusted profit walk, which explains year-on-year changes from last year's reported number of £174.3 million, shown in blue on the left, And moving across the chart, like-for-like NRI growth improved profits by £6 million. Net acquisitions over disposals increased profits by £5.5 million. And the full-year effect from completed developments, principally Terrasse du Port, boosted profits by almost £10 million. Premium outlets provided an uplift in profits of £5.9 million. There was a small year-on-year improvement in administration expenses. The overall cost-income ratio rose slightly to 23.1% due to higher property costs from pre-development properties such as Croydon and Martineau Galleries in Birmingham. Interest expenses reduced by £12.3 million as a consequence of refinancing, and more on that later. Foreign exchange and other items reduced profits by £3 million, resulting in a 2015 profit figure of £210.9 million, up a strong 21% on last year's figure. So turning to the property valuation, we've segmented the portfolio by sector, and these changes are shown in constant currency. I'm going to review the movements in the first column of numbers before addressing the key drivers in the grey box. So the largest segment, UK shopping centres, was up 6.8% over the year, and this was caused by around 25 basis points of yield shift, plus 2.3 percentage points worth of income growth. UK retail parks saw modest valuation growth of 1.3% in 2015, as income gains were partly offset by some slight negative yield movements. In France, our investment portfolio was up 7.1% due to an average 40 basis points of yield reductions. And developments were up 12.3% in the year, boosted by our projects at Leeds and the Goods Yard. The final major segment, premium outlets, generated capital growth of 16.4%, of which around 60% was driven by excellent income growth. So overall, the total portfolio value had a capital return of 7.1% and was valued at £8.4 billion at the end of 2015. Shown in the bottom is our investment in Ireland, which we held at cost at 31st December 2015. This amount of £690 million is supported by an underlying independent property valuation. Now moving on to NAV per share, in this walk I illustrate the movement from the value of 638p per share at December 14, shown on the left. Valuation increase in our property portfolio increased NAV by 47p a share, and our investment in premium outlets was up an equivalent to 22p a share, with notable gains at Bicester Village and La Vallée in Paris. Adjusted profit contributed 27p a share, and dividends paid out reduced NAV by 21p a share. There was a small 3p a share decline from other items, and that takes us to an NAV per share of £7.10, up 72p, or an attractive 11.3% over the 12 months. Now, shifting to the analysis of debt, our balance sheet remains strong. The December 2015 column in the middle shows total net debt was a little less than £3 billion, up from the end of 2014, primarily due to acquisitions and development capex. Gearing and LTV are comfortable at 54% and 38% respectively, and lower than our financing policies. We had substantial liquidity of £931 million at December 2015 as a result of an exceptionally busy period of refinancing. The bottom half of the table looks at some detailed ratios, and as you know, we've been targeting the weighted average interest rate, which has fallen by 90 basis points to 3.8% due to our new bond and bank deals. Less than 4 years ago, this weighted average interest rate was over 5%. Interest cover and net debt to EBITDA ratios are in line with our policy guidelines. Now, there's been a lot of investment in refinancing activity over the last couple of quarters, so we've summarised the key changes in this table. In the left-hand column, we show the position at 31st December 2015, which, as I just mentioned, illustrates net debt of nearly £3 billion and LTV of 38%, shown in the bottom row. Please note the real estate values which drive the LTV include our share of Irish investments. Moving right, we add the acquisition of 50% of Grand Central and the recent disposals of properties at Villebon and Newcastle, which maintain LTV at 38%, and this is today's position. The next pro forma column shows the effect of converting Dublin loans to property, which is expected to cost £220 million, as previously announced. This raises forecast net debt to almost £3.2 billion and LTV to 39%. Now, finally, our planned 2016 disposals of £300 million will cause projected net debt to fall to less than £2.9 billion and LTV to fall to 37%. And this gives us sufficient capacity to fund our near-term developments. So moving on to projected development capex, and first some historical context. As shown in the grey dotted line, we've deployed almost £600 million since 2013 on successful projects such as Terrasse de Port Marseille, at Beauvais, Rugby and Merthyr. And this was done at an annual run rate of almost £200 million and financed by disposals. The on-site schemes are dominated by projects in Leeds and Southampton and are shown in the blue bars. They only require £120 million to complete, which is easily manageable. Pipeline schemes at Croydon, Brent Cross and Goodsyard have a headline cost of £1.3 billion, our share, but are phased over 5 years and with no major commitments until 2017. In Croydon next year, the main element of the cost is property acquisitions. Therefore, we have flexibility to launch these large schemes depending on economic and real estate market conditions. We plan to fund these projects from incremental asset sales. So finally, for me, future financing activity. And the bar chart here shows our debt maturities which are spread evenly across 12 years. Looking at the box in the top right, we executed over £1.7 billion of financing transactions in the second half of the year, including a new £1.1 billion acquisition facility, a £350 million 10-year bond, plus an early bond redemption. Looking forward, we plan to extend our 2017 bank facilities with a new long-dated revolving credit facility and other debt issuance, using the benefit of our reaffirmed credit ratings of Baa1 and A-. So we're confident of achieving these refinancings. Overall, our growth plans are therefore well supported. So that's it from me, and now back to David.
Thank you, Simon. So we're now going to take a slightly more detailed look at the portfolio performance. But before I do that, this slide recaps on the shape of our portfolio today. In 2015, we strengthened our position in core prime shopping centres and grew our unique strategic exposure to premium outlets, both in line with our stated strategy. Together with our core focus on retail parks, the portfolio is well diversified across winning segments that play to shopper preferences for, as I've said earlier, experience, convenience and luxury shopping trips. And we're delivering positive operational results right across the board. Occupancy increased by 20 basis points to 97.7%. And we signed 400 leases. And, driven by the increasing tension in demand as retailers look for scarce premium space, we signed leases at 10% ahead of previous passing rents across the group investment portfolio. So let's look now at our shopping centres in the UK. The successful acquisition of Grand Central with CPP added one of the year's most highly sought-after assets to our portfolio. As a reminder of the key attractions for us, Birmingham benefits from the fastest-growing disposable income in the UK outside of London. And the Bullring monthly average sales growth was up 5% last year. Grand Central is perfectly positioned within the £750 million New Street redevelopment as the gateway to the wider city, capitalising on exceptionally strong footfall, and the centre is close to fully let. But with Zone A's some way below the rest of the city and growing demand for retail and dining space in prime locations, there is an immediate 12% reversion and material further uplifts from useful adjacencies with Bullring. Overall, the deal provides a prospective IRR of 7 to 8%. Looking now at category sales performance across our UK shopping centres, it's clear from the detailed data we collect that consumer confidence is feeding through into increased sales, with particularly strong growth in discretionary and high-ticket categories such as jewellery. Now, whilst warm weather and deflation impacted fashion retailers over the course of 2015, tenant sales in total increased 1.3%, outperforming the wider market. But increasingly, reported in-store sales don't tell the whole story. Now, as we've outlined before, sales data through the tills understates the true value of physical stores. As customers become channel ambivalent, they are distinguishing less between shopping in-store, on a mobile phone, or at home online. Only last week, John Lewis dropped reporting of weekly store sales, with an admission that the growth in omni-channel is distorting the true in-store sales performance. But physical retail space remains at the heart of a multi-channel model, reflected by the fact that more pure-play online retailers like Amazon are now looking at taking stores. So how should we re-evaluate the role of physical retail space? First, stores play an ever-increasing role in the fulfilment of online purchases. The effect of online returns in-store results in an understatement of store sales. At the same time, online orders collected in-store are usually not registered through the tills. Combining these two effects leads to an understatement of store sales by around 10%. Secondly, the store has a halo effect for online sales within its catchment. The store provides regular contact with a brand, building awareness and loyalty. And our research found that this online halo effect secures around 5 to 6% in additional sales. And finally, even sales at pure-play online retailers now touch our centres. 2/3 of parcels through our Collect Plus desks are from pure online names. And when customers come to collect their Amazon or ASOS parcel, they rarely stop there. 85% of them go on to do something else in the centre, spending on average an additional £40 each. This demonstrates the accretive benefits of clicks to bricks and equates to around 1 to 2% of incremental sales. So taken overall, stores in prime centres generate as much as 20% in additional sales for retailers in today's multi-channel world. Turning now to leasing activity, we're continuing to see heavy demand from retailers for prime space across our centres. This chart shows all of our long-term principal lettings at the UK shopping centres over the course of 2015. As you can see, 73% are struck at or above ERV. Looking from right to left, the trends are broadly defined by retail type. The strongest demand and where we see the greatest rental tension is with new concept stores and catering units, where the growth in casual dining is driving demand for space. We still have a small number of deals struck below ERV, and primarily this is for tenant mix reasons, where we want to lift the quality or drive footfall into a certain part of one of our centres. However, the overall picture is very healthy indeed, with leases struck 3.5% ahead of ERV, and no change in average incentive packages during this period. As a result, ERVs are now growing at a healthy rate of 2.8%. And our additional commercial revenue streams are becoming increasingly diverse. As you can see from the chart on the left, revenues have increased 9% on last year, demonstrating an impressive CAGR of 11% over the last 4 years. This performance is particularly influenced by the growth of kiosks, with income up 29% in 2015, which in turn is driving footfall and dwell time across our centres. A number of the most successful kiosks go on to sign long-term leases, such as Tesla and Cath Kidston. And as you can see from the bottom left, our car parks continue to boost income, adding £23 million during the year, up 4% like for like. Now, moving on to Ireland, the newest geography in our European platform. Here first is a quick reminder of the quality of assets we have exposure to in Ireland. Dundrum undoubtedly is a jewel in the crown, a 1.5 million square foot super prime centre located in the wealthy southern suburbs of Dublin, and with more international brands than any other shopping mall in the country. Following the transfer of loans into assets, we will own Dundrum 50-50 with Allianz. The portfolio includes 2 other shopping centres, Pavilions, close to Dublin's airport, and Ilac Centre in the city centre. We will take 50% ownership stakes in both, alongside existing co-owners. In total, the portfolio provides 27 acres of development for future growth and a forecast IRR of 7 to 8% pre-development profits. Now, as a reminder of the financials for the acquisition, we acquired the loan portfolio 50-50 with Allianz. The loans have a face value of £960 million, for which we have paid £690 million for our 50% share. There are some taxes and costs associated with the transfer, and we'll make a balancing payment to Allianz for their share of Pavilions, Ilac and Dublin Central, since, as I mentioned, we will only own Dundrum in a JV with them. But our final commitment remains forecast at £910 million, as stated at the time of the acquisition. Negotiations with the borrowers are continuing to progress well, and we remain on track to convert the loans to property assets by the summer of this year. Now, as demonstrated by the statistics on the left-hand side, the backdrop in Ireland remains incredibly strong across all metrics. Indeed, it's strengthened since the time of our acquisition. Consumer confidence is at an 8-year high, with retail sales up almost 4% in 2015. And as the chart on the right shows, there is a clear recovery in Dublin retail rental levels, and the ingredients are in place to drive further strong rental growth over the coming years. And as I've already mentioned, Dundrum is one of the best performing assets in Europe, so it's well positioned to benefit from this rental growth trend. This slide demonstrates the strength of a handful of deals signed since our acquisition, which reinforce that position. Tommy Hilfiger took the opportunity to upsize, moving into a more luxury part of the centre, resulting in a rental uplift of nearly 30%. And since Zara's upsize, the store has enjoyed sales up 40% year on year and is now within the brand's top 15 globally by sales growth. And sales growth across the centre generally remains strong, up 6% in 2015. Now let's move to our French portfolio. There we go. So let's move to the French portfolio, where again it's been a very active year. We've followed a clear strategy over the last 3 years to improve the quality of our French portfolio in order to lift returns. This included refurbishing all of our centres, investing in improved customer surroundings and retailer facilities. We've been recycling capital, selling assets such as Angers and Bercy, where we have exhausted asset management and planning options, but where we're able to achieve good pricing, 15% ahead of book value. We've reinvested this capital into new developments, delivering a healthy profit on cost of 35%, and in the acquisitions of assets which are better positioned in a polarising market. The renewed and refurbished platform has enabled us to attract a host of new and exciting brands. In 2015, we re-tenanted 78 units, just under 10% of our portfolio and ahead of our plan. We introduced 25 new brands, 4 of which were completely new to France, delivering a sales uplift of approximately 20% at re-tenanted units, and importantly, maintaining a healthy level of rental tension, with leases signed nearly 10% ahead of previous passing and 1.5% ahead of ERV. And as a result of re-tenanting and these other actions, sales have turned positive in 2015, up 0.6%. And this figure includes all of our centres. If we were to exclude centres under refurbishment, such as Cergy, then sales growth would be 1.6%. And this, in turn, has generated good NRI growth at a time when indexation is falling. NRI, shown on the orange line, has grown steadily to 2.5% in 2015. Now, looking at retail parks, a number of you may recognise this picture from our Capital Markets Day back in November, when we opened the newly developed Elliott's Field in Rugby. As a reminder, we have a clear strategic focus on only 3 sub-segments of the retail parks market, as shown by the dotted blue box on the top left of this slide, with 80% of our portfolio positioned towards the segments offering the highest rental growth potential. Now, our exposure contrasts with the rest of the market, as you can see from the pie chart on the bottom left, where the majority sit in the lower growth, solus and standard homeware parks. As a result, our portfolio is better positioned for future growth. Leasing remains strong across all 3 categories, although the volume of deals has been highest at shopping parks, where the recent opening of Elliott's Field secured deals including First Fat Face on a retail park in England, a full-line Debenhams and M&S department stores, and River Island. In our hybrid and homeware parks, we've seen the fastest rental growth, where vacancy has been absorbed and expanding brands such as Next and Oak Furnitureland are competing for space and helping to drive rents forward. These deals are now generating rental growth across the portfolio as a whole, albeit at a slower rate than UK shopping centres, with leasing versus ERV up 4.2% and ERV growth of 1.3%. Now let's turn to our fast-growing premium outlets portfolio. We continue to deploy capital to this high-growth sector, both through our investment in value retail and through the turnaround VIA fund. During the year, we meaningfully increased our ownership stake in Kildare Village, taking it from 14% to close to 40%. Kildare had a particularly spectacular year, with sales growth up 26%, demonstrating both a positive economic backdrop and also the benefit of the successful extension, which introduced over 30 new luxury boutiques. And as announced this morning, we also acquired a new outlet as part of VIA. Festival Park in Mallorca is the country's only major outlet centre, welcoming close to 4 million visitors per annum. It already has strong brands, including Tommy Hilfiger and Calvin Klein. But we're excited about the future potential to further reposition it and capture future rental growth. Premium outlet sales continue to outperform, with value retail up 11% and VIA up just under 10%. And from this slide, you can see the impressive sales density the VIA outlets achieve, and also the opportunity to raise the VIA performance closer to this. This strategy is already proving successful, using relationships and networks built through our partnership with Value Retail to introduce brands to the VIA portfolio, including Coach, Desigual and Brooks Brothers. VIA sales densities have already lifted by 11% as a result of this. Although sales growth is supported by the domestic local catchment, international tourism represents a significant percentage of sales growth. As a proxy for this, the chart on this slide shows tax refunded sales from international tourists in Europe. You can see it is split by the nationality of shopper and shows the growth rates of each nationality on the left-hand side. As you can see, China makes up the majority of international sales in Europe at 43%, and other Asian countries make up 19%. Now, despite the recent slowdown in the macro outlook for the Greater China area, luxury sales were up 32% in 2015 and up 20% across the rest of Asia. Furthermore, despite the sharp decline in the oil price, sales were up 18% from tourists in the Gulf region. Russian spend, which now contributes only 5%, has performed poorly as a result of currency and geopolitical events. But the resilience of total outlet sales growth in Europe is supported by the structural growth in international travel and also the diversity of the global shopper. As well as these major contributors, countries like India and the USA make up the other category, and these were also up double-digit in 2015. And finally, let's move to our developments. At Victoria Gate in Leeds, we're making great progress on site. As you can see from the picture, the development is really taking shape, and John Lewis has now taken possession of their store for fit-out. The scheme is now 68% pre-let, up from 51% at the half-year, and we remain very confident about the potential to drive further value from this development once completed later this year. And then moving to Southampton, our other major on-site development, Watermark, continues to progress in line with plans. The scheme is set to create an £85 million dining and leisure hub for the local catchment, complementing the success of our major West Quay shopping centre. Targeting a completion a year from now, the scheme is already 80% let, with an impressive range of catering brands, as you can see from the bottom of the slide. Moving now to our major London development pipeline. 2015 was an important year in progressing our Croydon development. We made key land acquisitions, and anchor discussions continue to progress well. As a result of slight delays in receiving CPO confirmation, which the Secretary of State confirmed in September, the project start date has now moved to 2017. But with the site assembly taking shape, we have narrowed our capex assumptions to within a range of 650 to £700 million and are finalising detailed designs for the scheme. At Brent Cross, we achieved major infrastructure consents and successfully secured a government infrastructure funding package to include a new mainline railway station. We're now focused on working up scheme designs, securing anchor commitments and preparing for the CPO inquiry, which is scheduled for May of this year. The wider regeneration of Brent Cross Crickwood is also well advanced, with Barnet Council and Argent Related set to provide additional infrastructure and up to 7,500 new homes in the area. And finally, following revisions to height and commercial workspace at the goods yard, we submitted a revised planning application in the summer of 2015. The scheme was called in by the Mayor of London at the end of September last year, and we await his expected determination next month. As a result, start on site is planned for 2017. We continue to see significant potential for this regeneration project, restoring the heritage and delivering much-needed housing, employment and flexible workspace, as well as creating an exciting new retail destination for Shoreditch. So to wrap up, we have a resilient business model. We continue to enhance the quality of our portfolio through disciplined investment management. And our strategy to focus on prime retail assets in areas with strong occupier demand continues to deliver a strong performance. Because of these strengths, whilst we recognise the global economic and political uncertainties, we remain confident that the business will continue delivering sustainable and attractive returns for shareholders. Thanks very much. Let's now hand over to you for your questions. So I think we've got a question at the back there.
Hi, David Prescott from Barclays. You did a good job of explaining how sales in stores are understated by maybe up to 20%. And then we see that store sales growth is about 1.3%. What would that growth number look like year on year if you were to include these sales that aren't being included? Would it be much higher than 1.3?
Well, in simple terms, arithmetic terms, you add 20%, so it would be head to sort of high ones towards 2%. I think, though, what is also you need to appreciate, and I mentioned in the presentation, you're seeing quite substantial deflation, particularly in fashion. So against those headwinds, a figure approaching 2% we think is a very credible growth figure. And actually bringing it right up to date, we're seeing momentum in sales in our centres, so a very good Christmas, and into January an improving figure. So I believe that those figures will grow from here.
Some of the luxury brands presumably have been struggling recently with China and the like. Have you seen in recent months, I appreciate it's been a good year, but in recent months, any slowdown in your premium outlet sales?
Pam, do you want to cover that from an outlet point of view?
I think it's fair to say that the terrorism atrocities and the climate were not positive to revenues in November, December and January, but across the board, and remember we own investments in 15 centres, they've continued to be positive year on year at the sort of run rates that you've seen. So this is the beauty of having a diverse portfolio, and as David mentioned, lots of different territories coming to our centres, and our domestic catchment is spending quite nicely. So yes, some ups and downs, but nothing to deflect us from our medium-term target in terms of double-digit sales growth.
Thanks.
Hunt.
Morning, Remco Simon, Kempen. Simon, you mentioned that you, in terms of financing metrics, you are within your policy limits. Yet, I'm not sure, maybe you can elaborate on that a bit. What is your view on where we are in the cycle? And given where yields are, wouldn't you want to be a little bit further below the policy limits if you look at net debt, EBITDA or LTV than where you currently are at?
Yeah, it's a fair question. So clearly the company has a very exciting, substantial development programme looking forward for the next 5 years. We continue to monitor a variety of credit metrics, not just balance sheet ones like LTV, but interest cover, net debt to EBITDA. And that's why I said very clearly in the script that we plan to fund our medium-term development programme from disposals. We're open to doing more disposals beyond the £300 million that we've focused on for the refinancing of our Irish expansion. And it's worth bearing in mind that over the last 5 years, Hammerson on average has sold about £350 million of assets per annum. So selling on a regular basis, bottom slicing the portfolio, in our view, is the right way to maintain an appropriate balance sheet. As for the cycle, it's a very difficult question, Remco. We're alive to various different trends, but on the other hand, we're very comfortable about our financing position, and we believe we have a strong position to grow in future.
Elaborate or question you a little bit more on asset sales. The 300 million plus the potentially 1.3 billion to fund the pipeline. What kind of assets are you looking at disposing? Can you indicate a little bit more what is on the list?
So if you look at what we've done over the last 12 months, we've sold a retail park in the UK, a retail park in France, a small secondary shopping centre in the UK, and a couple in France. I think going forwards, we would follow the same pattern. This is about not geographical split, it's about bottom slicing, as Tom said, the portfolio from a future performance point of view. So it's not any one sector that we're targeting, it's taking the portfolio as a whole. And I think just bringing this bang up to date, it's worth remembering, as Tom said, this is what we do, bottom slicing the portfolio. But since Christmas, we've announced a sale in France, 10% above book value, and only on Friday, so signed on Thursday, in effect, CPPIB, a global pension fund, have acquired a 50% stake in a major new shopping centre at the same price that we paid for it. So, there's some very clear current guidance there in terms of activity in the market, and I think that we remain confident about those sales through this year.
Last question. Could you remind us what the yield on cost is on Brent Cross and on Croydon? Because the construction cost range on Croydon seems to have narrowed a bit to the upper end.
Peter, do you want to cover that question?
Yes, we've advanced the Croydon project, so we're now more precise on the scheme design in terms of free levels, the anchor store positions. So we're going for a detailed planning application this year to refine that. And we will maintain targeting a yield on cost of 6% on the super regionals, Brent Cross and Croydon.
Sorry, Alan Carter, Stifel. I'm just trying to get a handle on sort of core portfolio growth. At H1, you said that leases that had renewed or reviewed achieved 16% above previous passing. That figure for the full year, I think you disclose as 8.8%, which would imply a very, very significant slowdown in rents passing in H2 or for the full year over H1. I mean, I wonder whether you can just explain that, please.
I think, no, Alan, I wouldn't draw that conclusion. I think it clearly depends on which leases we're renewing when and what the previous rent was. So I think you've got to look at the year in question. I think that you also need to look at the ERV growth, which, remember, is an independent number, not ours, of approaching 3% in our UK shopping centres. So I think there's generally good demand for space, and I think the rental growth figures that we're showing bear that out.
Can I just follow up on that? Because I think I'm right in saying the square meterage that was renewed in H2 was virtually identical to H1. So, I mean, that would imply a huge variation in the quality of the assets that were subject to review or new leases in H2. Is that an interpretation?
No. I think, again, you can be renewing a lease on an upper floor which has a higher rent versus the renewed rent and vice versa. So I think it is simply down to the phasing and timing of individual deals. But I think even achieving a overall leasing versus previous rent passing growth of 10%, which is what we've hit as a run rate for the last few years, I think is appropriate and very credible.
Okay, and just one more actually two more, but one more as a follow-up. Just again referring to H1 against the full year and the profile of lease expiries and breaks in the portfolio. At half year, you said that in 2016 there was approximately 13.6 million of income subject to lease expiry or break in 2016. That figure's now risen to 45.2 million. Can you explain what that is, please?
Well, I think Simon sent you an email earlier on that one. Maybe you haven't read it, but
about an hour ago. But the answer is holding over. At the half year, we have transactions which were in negotiation with tenants on. That's included in the 2015 number at the half year. Not all of those have been settled, so you push it into 2016. So at this time of the year, in February, we have a whole year looking forward, plus the previous years which are added in. So it's a consequence of the spillover from deals which are still in negotiation from 2015.
So it's the same as the outstanding rent reviews that you disclose?
Yeah.
But entirely separate, obviously.
Yeah. We could rename it outstanding.
Yeah.
Okay. That figure's increased dramatically over the 6 months. So if I sum the 15 and 16 figures from the year end, the outstanding reversion's gone from 6.9 to 9 million, which seems a slightly disproportionate rate of growth.
Well, I see that as a positive, Alan, because that means we're going to be able to increase rents going forward, which sounds to me like we're going to boost like NRI growth. So I'm pretty chilled about that, particularly if ERVs are growing by nearly 3% on average. I think that's embedded growth.
Okay, thanks very much. Oh, sorry, one more. The reversion on Grand Central, is that burning off for rent-free periods, or is that ERVs above passing?
No, that is two things. One is letting, there are a handful of vacant units, so that is about half of that reversion. And then there will be reversion through rent reviews over the course of the 5 years.
Okay, brilliant. Thanks very much indeed.
At the front here.
Morning, gentlemen. Mark Muzzy from SocGen. I have two questions on my side. The first one is, if market conditions were not what they were when you acquired Grand Central, would you have been considered a capital increase to fund it?
Sorry,
if market condition, equity market condition, were not what they were at the time you acquired Grand Central, would you have considered raising equity to fund that acquisition? Did you thought about raising equity?
I think what we've done is acquire that asset, and we've set out a very clear financial plan to fund it, along with Ireland. We talked about disposals. That is a very clear plan. In terms of other forms of capital, then I never rule anything out, but that is not our core plan.
Of raising equity?
Correct.
Okay. I'm right thinking that you indicated an EPS growth at some point over the next 3 years of 8% historically?
6 to 8% is our guidance for earnings going forwards, yes.
So we move from a plain 8% to a 6 to 8%?
No, we've been at 6 to 8% in terms of guidance for the last 3 years.
Okay, thank you.
Morning, Michael Burt, Exane BNP Paribas. I just had a follow-on really from Mark's question around earnings growth guidance. You've been very clear that the sort of 250 million per annum of development capex you've got in the pipeline from sort of 17 onwards will be funded through disposals. Given that you lose the cash up front maybe from those disposals, but you don't necessarily get the payoff in income for a while, what other moving parts give you the confidence to still point to 6 to 8% dividend growth through that period?
Well, it's a number of things. So embedded income growth that we are delivering in the portfolio, obviously full year effect of any acquisitions and completing developments. So I talked about Leeds and Watermark coming forward. And obviously on the cost side, we continue to work hard on our cost line, particularly the interest expense.
And then just one on ERV growth, if I may. I think historically you've talked about a 3% per annum target for ERV growth in UK shopping centres. France and retail parks, underperformed that level this year. I mean, what should we think of as sort of, an attainable target for France and retail parks in terms of ERV growth?
Well, to be clear, the 3% guidance was on UK shopping centres, and at 2.8%, we're not far short of that. So, and I maintain that guidance. Retail parks slightly behind the UK shopping centres at 1.3%, but catching up relatively fast. But I would guide somewhere between 1.5% and 2% going forwards. France, a little bit behind UK, so I think 2% is attainable, but not for the first, the next 12 months. So I'd be looking more from 18 to 24 months from now.
Hi, good morning. Hemant Kotak from Green Street. You've been much more acquisitive than some of your peers, and I just wondered what the appetite is for 16 to acquire some more if such opportunities presented themselves.
I think the ambition is about improving the quality of the portfolio. That is really what drives our business. I hope that was made clear in the presentation. So whilst we'd never rule anything out, I think clearly having had a fairly active period in the last 12 months, our focus for the coming year is very much embedding those assets into the portfolio and preparing for our next significant wave of developments, indeed completing the existing ones. So that's probably more the focus for 2016.
Great, thank you. And as you think about net investment, how do you think about that? So whether it's acquisitions or development capex, in the context of potential share buybacks funded by asset sales that go way over and above the 300 million that you've indicated, because your shares obviously are trading at a material discount today.
Well, it's something we look at from time to time, but I think when you look at our capital deployment plans over the long term and the long-term growth that we have and believe we can provide for that capital, then it's not something we are looking at the moment.
Okay, thank you.
Good morning. It's David Brockton from Liberum. Can I ask two, please? Firstly, just in terms of the cost ratio, can you just give us an update in terms of what more you think you have to do there? And are you still targeting 21% by the end of this year?
Thank you. So on page 59 of the pack, there is some detailed analysis of the cost-income ratio. It went up in 2015 versus 2014, as I mentioned. We were fortunate enough to reduce the corporate overhead element. As you know, we've been working very hard on our corporate overheads. The property expenses ratio, however, went up, largely because we acquired a number of quite expensive pre-development assets, in particular the Whitgift Centre in Croydon and Martineau Galleries, which is a development opportunity in Birmingham. So they pushed up the ratio overall. You are absolutely correct in remembering 21% being a target. That's still an aspiration for 2016. You know, it may be 21 something. I can't promise it will be less than 21. Let's see how it goes. But we are very focused on running our assets efficiently and maintaining a good procurement policy in order to reduce the cost-income ratio to boost dividends per share, as David just said.
Okay, thanks for that. And just sort of following on from that, just as you look at the like-for-like net rental growth numbers, is there any discernible difference between what you're seeing at a gross level to a net level?
No, not really. I think you might remember when I presented the net rental income slide, I said the UK shopping centres, the gross rental income was up 2.5%. So it's pretty similar, and that's across the board. Remember, the Hammerson accounting policies are very conservative. We book as expense pretty much every cost that's going, which tends to make our NRI growth be steady, but not spectacular. And that's a consistent policy we've followed for many years. So GRI growth and NRI growth are very similar.
Thanks.
One at the front here. At the back, yep. Sorry, Tim.
Morning, Tim Leckie, JP Morgan, Cazenove. Just one quick one. Lots of concerns about, well, practically anything you like at the moment in the market, but credit spreads and funding costs is one of them. Notwithstanding the already strong result bringing down that cost of debt, can you give us any flavour on how conversations with banks are going at the moment, particularly relating to the 2017 facility? Is that an opportunity to lower further, or is that already on the floor in terms of how far that rate can go down?
I'll answer the question in two parts. How do we see credit markets, and what about the engagement we have with our banks regarding the 2017 revolving credit facility? Overall, I think clearly there's a lot of volatility, but similar issuers to Hammerson, let's call them large European shopping centre companies, have recently being very successful in the bond markets, and Moody's reaffirmed our Baa1 rating this morning. Therefore, we are very confident about our position to term out that revolving credit facility. Banks in general are great supporters of the company and have been for many years. Some of them are in the room today. So we are very confident about extending our core revolving credit facilities at very attractive margins for shareholders.
Thanks. Oliver Reeve from Deutsche Bank. Just one question on the timing of those divestments going forward to fund your development programme, and whether you would look to do more earlier in order to shore up the balance sheet a bit more in advance of heading into 2017. Thanks.
So the £300 million of asset disposals we've highlighted, we're guiding during the year. Our plans are in motion. I take the point, but I think that looking at this today, I wouldn't want to overpromise. There may be an asset disposal around the middle of the year, but broadly it's 2016 as a whole. Reflecting we've sold 360 million in the last 12 months. In addition to that, the 175 million effectively disinvested from Grand Central last Friday. So, we're not hanging around, but we'll work on it as quickly as we can.
Thanks.
Any further questions? Are there any questions over the wire?
Press star Yes, good morning, everybody. Just have three topics that I would like to tackle. The first one is in Ireland. I think you indicated progress is as planned. Could you just elaborate a little bit more, and in particular, I don't know if you can comment if a letter of intent has been signed with Joe O'Reilly, or maybe less specifically than what remains to be done for the loan-to-own process to complete. Then in France, could you comment on the pickup in tenant and administration, and is this why the income effect from revaluation was negative, even though ERVs and like-for-like were flat to positive? Still in France, national.
So let's start with Ireland. As I said, this is a live transaction, so I can't be too open about the state of those negotiations. But what I can say is that we are in active and positive dialogue with the borrowers. It's a complex transaction. We have a number of counterparties, a number of loans, a number of assets, but we are confident of converting the loans to real estate by the summer of this year. In terms of then, second question, Timon, on the...
So I think the question was associated with the valuation drivers for the French portfolio and how did the yield get negatively impacted by income declines. Yes, we did see some ERV declines in our French portfolio, and that has been taken in the valuation at the year end, relatively modest. You would have seen overall ERVs were flat for our French portfolio on a like-for-like basis, but on a valuation basis, we did take some modest ERV declines. So I think Beauvais leasing.
The ERV decline is mainly focused on the Sky West, by the way, where we decided to go to a leisure scheme rather than the traditional retail scheme, hence a lower ERV. So it did not impact the entire portfolio. The second one was on Beauvais. Beauvais opened at the end of November. We have opened 9 units since the opening, and it remains roughly 20 small units to let. They are being in process of being let. The scheme is working well. We expect to welcome more millions visitors in the course of early the first fortnight of March. So it's kind of promising.
And there's a retail sales versus national benchmarks question.
Well, again, I think overall we would target obviously a figure above national benchmarks. A figure of 1 to 2% above national benchmarks is generally our target. But as I said, you've got to be very careful, about our own sales figures, and an adjustment is required to take account of those online sales, which effectively are not stated through the tills, but also the benchmark itself. Which benchmark are you using, whether it's pure physical or physical and online as well. But 1 to 2% outperformance.
Great, thank you very much.
Okay.
Morning, chaps.
Hi, Marcus.
Thanks very much for an excellent presentation. Question on UK retail parks. You were kind enough to make the comment that the like-for-like growth was benefited from the increase in surrender premiums.
Okay, so yeah, we took a couple of surrenders, one from a Homebase and one from a Tesco Home Plus. One of those has been relet, marginally lower rents, but not significant. And the Homebase in Scotland, we're looking at breaking up into 4 units. There'll be a cost of about 7 million to do the works, but we're currently forecasting a profit of about 6 million on that expenditure. So as you work through the next 12 months, you will see a net improvement from that activity.
Okay, we can debate offline.
Just to finish, the surrender premium is a very small percentage of the increase in like-for-like net rental income, but we'll give you the detail when we meet.
Okay, lovely, thank you. And then on Vic.
Hi, Marcus. So our VIA sales grew by 9.6% in calendar 2015. The occupancy decline you're talking about is by the end of the year, we put in place some significant reconfiguration programs at Langhart, south of Zurich, and at Alcacete, south of Lisbon. So the year-end occupancy number is quite a bit lower than the average occupancy during the period. And this reconfiguration program is exactly what we like to do in VIA, which is upgrade the centres and using some of the techniques and skills that Value Retail have developed over many years. As far as sales density is concerned, you will have seen densities go up to a bit more than 3,000 euros per square metre in VIA. We'll continue to march forward, bringing in exciting brands like Armani, Tommy, and in due course, Polo in a couple of units. So we're very pleased about VIA. Teams are working extremely well, and we're delighted about acquiring in Mallorca recently. We think that's got a lot of legs, great tourism island, and we can bring some of the magic from Value Retail to play there.
Simon, thank you. Your enthusiasm is infectious.
Good.
What I would really appeal for, gents, is that we have, these are great, you've got a lot of big positive numbers here, big percentage increases, but it's costing money to get this increase. And here at VIA is a classic case. You're spending X number of hundreds of thousands of euros, if not millions, in getting these increases. And I think it's only fair for investors that we get a bit more colour on that in future. So that's a request. Final question from me, because I'm sure everyone wants to get off for a cup of tea. Just performance of the portfolio versus this is back to the entire portfolio, versus IPD. Appreciate it's very difficult because there are no premium outlets in the IPD data, but it would be really useful for us to have a look at how your portfolio X the premium outlets did versus your IPD metrics, your KPIs, etc. Otherwise, we're sort of slightly comparing apples to pears, albeit you have deliberately gone into premium outlets because you think it's going to do better than the rest of your portfolio, or certainly parts of it. But that if you've got those numbers to hand, that'd be great. Otherwise, if we can have them a bit later. Thank you.
Well, Marcus, just quickly, and on the expense point, as Simon said earlier, the majority of cost that we expend to run this portfolio, we do expense, we don't capitalise. So, we keep saying it, that these net numbers are a good indication of the true growth in income. And secondly, outlets obviously have had a great year, so you can knock about 1.5% off our 2.5% outperformance, excluding the outlets. So still 1 to 1.5% outperformance from the core portfolio, which is, again, a very good performance.
Thank you, gents.
Okay.
There are no further questions on the telephone at this time.
Is that no more questions? So I know you're all dying to dash off and get back to your day job. We've talked a lot about experience and how we drive the assets through a product experience framework. if you don't mind, we've just got a 2 or 3 minute video to give a little bit more colour of what that really means and how we drive the management of our assets. So if we could finish with our video. In 2014, we launched our Product Experience Framework initiative to differentiate how we operate. The framework is embedded within the business and impacts everything we do, right from design and development to leasing and asset management strategies.
In 2015, we've made fantastic progress delivering services that drive footfall and increased dwell time across all of our retail destinations.
There's something for everyone. You've got all different kinds of shops, which I like. There's jewellery shops, there's kind of high street clothes shops, there's more sophisticated brands, you've got food, you've got different types of coffee. I think it's great, like there is something for everyone.
It's much, much more than shops. It's an experience.
Click and Collect is now in 4 of our shopping centres and is doing extremely well. It's outperforming our expectations. We're rolling mobile phone charging units out across our portfolio and we're seeing fantastic usage. It's something that's really helpful for our customers.
I think it's really good because you've got the Amazon lockers, which are amazing.
And I like that I can be anywhere in the world and I can go on topshop.com and order it to Brentcross Topshop and I know that I can pick it up. So I think it is good.
The centre has kept right up to date with the new trends in social media and the innovation. For example, the Plus app, which works really, really well for us and some of the other stores.
We'll be launching a new version of the app in the next few weeks. The key thing is it's a new look and feel, but also a bunch of new functionality so we can reward our customers directly for loyalty.
We're constantly challenging ourselves to deliver best practice in sustainable retail design and digital solutions. The Hammerson team has a broad range of experience covering retail, digital and consumer insight. But we're also looking beyond our business, building partnerships with a diverse range of organisations, including MIT and Henley Business School, to ensure that we maintain our competitive edge in the market.
Looking to the year ahead, there are a number of key areas of focus. First and foremost, we're looking at the family experience. How do we improve their services and increase dwell time for that key target market? We'll also be providing shoppers with improved facilities and premium services like hands-free shopping and concierge desks to better support the customer journey. We're looking at how we bring our centres to life using innovative food concepts and unique events with an aim of driving footfall and customer loyalty.
Great. Well, thanks very much for your time. We're here for a few more minutes if any further questions. Otherwise, have a very good day. Thank you.